Hello, welcome back. One of the subscribers of our channel had a very sensible question, which I actually haven't thought about before in terms of making a video. And I think it does deserve its own video, its own allocated video for this one. And the question was, let's say I own a company like Meta, like Facebook or Alibaba. When do I sell? What is the proper time to sell? Now, of course, more than likely right now may not be the proper time to sell, it's probably the proper time to buy. But when that time comes, how would I know what's the proper time to sell? Is what the person asked, the viewer asked. And thanks a lot for this question. I think this one is very interesting. Actually, this viewer actually mentioned that they owned Alibaba since it was about $300 or so at some point, and they have been owning it for quite some time now after its IPO days, and they are seeing the stock going down tremendously lately. And of course, they want to see when the stock gets higher at some point again. Maybe 300 would be the time to sell the stock. That's the secondary time. And so this is what we're going to examine in this video. Now, when we are going to sell a stock or buy a stock needs to be governed by the financials of the company. Of course, taking profit at any point is a good thing. I mean, if you think that it's time to get some profit and take some money off the table, then why not? You can always do that. But if you're a long-term investor, you typically want to be taking money off the table when it's appropriate to take money off the table. And let's just examine a company like Meta to begin with. And I'm gonna do this little exercise with Meta and Facebook. Although the person that asked about it was about Alibaba for the most part, I'm gonna do it with both Meta and Alibaba in this one, just to give you a couple of examples. So the first thing that you need to know about our tool, for example, here, which I'm using to analyze, is that if you go to the financial statements and let's take a look at the income statement, for instance, here, you're noticing the periods here, which is like annual periods. But if you also take a look at the quarterly, you're going to see that this gets Q1 of 2022, for example. And as new quarters come in, all these values are going to be populated, and the same goes with the annual period. And so when we do our stock evaluation tool here, this is going to be affected by the new quarters and the new basically years coming in, because this is a 5-year discounted cash flow model. And so using this data, we can deduce what kind of price to pay in the future as we are holding a specific company or potentially ever want to buy a company. And so let's say that we actually bought Meta right now as it is in $203. How do we treat that in terms of selling, that is? Now, first things first, we go back to our stock analysis tool and we do examine the initial things about the company. I have talked about the foundational metrics here of the company's analysis. There's a lot to see here: great return on equity, great net income margins, and of course, outstanding shares going down, price to free cash flow ratio and PE ratio that are looking pretty great. But we want something more concrete. What kind of value to pay and sell the company for? Now again, this is a scenario in which we bought the company today at $204. So let's use our stock evaluation tool and let's examine what that means. Now currently, this fiscal year 2021 is our last annual pretty much period that we can deduce financial information from. And this is our starting period for owning the company. Let's say we just bought it, of course. And so what we want to do is project what the company is going to be doing and be a little bit conservative for the next 5 years. This is a 5-year discounted cash flow model. And what does that mean? This actually means that we are actually projecting what kind of free cash flow the company is going to be generating in the next 5 years. Then we are discounting this cash flow back to today with a little bit of a margin of safety, which I typically use like 13%. And then we deduce how much we should be willing to pay for this free cash flow. It's mathematics, and it's one of the best ways to actually analyze how much you should be paying for a stock today in order to make a specific return into the future. And so with the revenue growth of the company, we have been seeing that it is sitting at about 30 to 37%, yet we do want to go more conservative here. So I'm going to go 15%, 17%, and 19% for the company's annual revenue growth, and that is for each of the next 5 years. And the net income margin is sitting at similar ranges, so I want to go something like 31, let's go 32 and 34 here for our highest estimates. And the free cash flow margin similarly very similar to each other. So let's go maybe a little bit lower, like 90, 95, maybe 100, maybe a little bit too much. So let's go 85, 90, 95 here. And an annual return of 13% is what I want to be typically making. And if I hit calculate here, you will see that if we bought the company today sitting at $204, our lowest projections here with this kind of projections, we are sitting still very nicely buying at $204, because the low max price to pay to date in order to achieve this kind of performance for our company in the next 5 years is going to be $203, $285, almost $286 again for our low estimates today, and the high ones are $410. Now what does that mean? This means that if we bought today at $203 bucks, then with a projection of 15% revenue growth for the next 5 years annually, 31% net income margin annually, free cash flow margin of 85% annually, we are going to be getting 13% return back on the money that we invested. And so if we bought $10,000 of Facebook in this case, then we are going to be getting 13% for the next 5 years if these projections come true. And of course, these are pretty conservative projections as well. Now, of course, this is the max price to pay in order to get these projections. As you can understand, if we paid $203, then we're getting a higher return, a significantly higher return, because we paid less. And so this basically gives you the max price that you should be paying in order to achieve this kind of performance for the low ones, medium ones, and high ones. And so as you can understand, as the years progress, and as we're, let's just say, in year 2025 at some point, then this table will have switched. Will have actually traversed through a year. It will be here it will be probably like 2020, 2021, 2022, 2023, 2024, for example. And so this will be the next few years as we live them. And so now we are looking at a different story. We're looking at a company that has actually increased their top and bottom lines. They have increased their revenue, their net income, their free cash flow every year. And so now when we do the same projections, again based on those historical averages which will have shifted, then we're going to be getting new values here. And these are exactly the values that we're going to be consulting in order to make a decision on when to sell. And as you can understand, because a company is about increasing its revenue, it's about increasing its free cash flow and basically making a better balance sheet, you will more than likely be looking at a company that is going to be valued much more, because this will have shifted. Like if you take a look at Facebook back into year 2010, for example, and compare it to this one, their revenue must have been something like I don't know, 5 billion, for example, and now they are sitting at 40. And in 2017 they were 14, 2021 they were 117. And the same thing will keep on happening through the years, with maybe a little bit of stalling, of course, because as the company gets bigger, then they get less revenue, less free cash flow, of course, less growth. But again, as years progress, you're going to be seeing a better picture in terms of the financials, and this is going to be reflected in the model here. And so eventually, 5 years from now, when you redo this exact same thing using the tool, you're probably going to be getting something like $400 for the low, maybe $600 for the medium, maybe $800 or $900 for the high. This is what is going to be happening, unless the company somehow goes wrong and things happen and they start losing money, and unexpected things occur. But as the company increases their financials, they keep doing better and better. They amass more free cash flow. That means that the stock price is worth more, and this is how you actually get a value to sell for. And the same thing applies with a company like Alibaba again. So if I do the same thing with Baba here, you will see that the first thing that we would need to examine in like 5 years' time would be the stock analysis chart and see what the company is doing in terms of its averages and how they are increasing their revenue and net income and all that. If they are actually buying back shares, what we typically do is what we need to be doing in 5 years as well. And so then the next step is to go back to our stock evaluation tool, and this will have shifted to, again, 2021, 22, 23, 24, 25 here. So it's going to be the 5 next years if we are taking a look at it in 2025. And more than likely, all these values are going to be maybe double or triple in the next 5 years. And so again, we're going to be taking a look at the averages here. We're going to consult our table. We want to be a little bit conservative, or maybe even a little bit less conservative if we're looking to sell for our high estimates here. And so for high estimates, we may use those as our selling point and be like, okay, if the company is reaching our high estimates, then it starts getting a little bit overbloated. It starts getting a little bit more difficult for me to make money. And so then I may be willing to sell because I'm getting a little bit of a premium for it as well. And so this is what I would probably do myself. And again, you can go something like this here based on the averages, and 100, 110, and 120, I guess, again based on the averages. And if we hit calculate here, you will notice that this value is much more elevated because we projected a higher revenue growth. And so when we're looking at this one, and let's just say that we have been holding the stock for a long while and it's now sitting at $500, then we're like, okay, in order for me to sustain this kind of return, the company needs to be doing 30% a year. Maybe it's time for me to sell. But if in order to sustain the growth, the company needs to be doing, let's say, 15%, and we are still looking at the green high projection here, then it may not be the time to sell right now, because there is a lot of milking to do for the company, right? Because it can very easily do this kind of revenue growth, and its current price is much cheaper than our high buy or sell estimate, depending on what we want to do. So hopefully that helps a little bit. This is how I would go about it, actually examine how much the stock and the company is worth today, and what are the projections, and see whether it actually makes sense to milk it or actually sell it because it starts getting overpriced. This is how I would go about it. Hope that video helped you a little bit, and I appreciate coming up with this very interesting idea. I think this is a cool idea for a video, and I hope it's gonna help a lot of people. If you did get some help, guys, please leave a like and subscribe. I'd love to see you around. And remember to watch this video that I made earlier. It's about Mercado Libre. And thank you for watching this one again. See you soon. Bye-bye.